Welcome to my channel, Balance Sheets Matter. In this video, I'm going to go over Dollar General, and it's one of my top picks, one of my top 25 I'm buying right now. I currently own some, probably add more in the future. And this top 25 I've created is from this video I just did, which basically last year I selected 25 stocks, let them play out for a year. And from August 26th to basically September 1st, I did the video a week late. I ended up getting about 28% return compared to the market's return of just under 13%. So I've selected 25 new stocks, and Dollar General is one of my top picks in here. So I'm going to do analysis on that of why I think it's probably one of the best buys you can do right now in 2023. So as many of you know, they came out with their earnings. It was called a disaster, and the stock dropped something like 12-13% because they missed on their EPS, they missed on their revenue, they lowered guidance, there's more theft at stores, everything seems terrible. But let's go look at the financials and really see what's actually happening and if this is really good, really a big deal. Because it really comes down to when a stock gets a big drop, there's a lot of opportunity, but there's also a lot of risk. And really how you can figure out if it actually is risky or just an overreaction is to see if there's actually any fundamental deterioration in the business itself, or is this something of like a larger macro factor such as a recession or the inflation, which we've currently had a lot of economic problems and the whole retail sector is doing bad. So the first thing we can look at Dollar General is their revenue. It's been growing very steadily over the years, and you can see that's also in line with they're opening new stores every year, like almost 1,000 a year. They're still quite growing at a nice clip. They're already quite a large company, so when they open 1,000 stores, it's actually not that big of growth. But good top line revenue growth. The gross margin, you can see, has been pretty stable, and even now it is stable as well. But you will see in comparison, when there was the great financial crisis in 2008, 2009, they were taking actually quite a significantly larger hit on their gross margins and on their operating margins as well. So even though the operating margin this last quarter is just under 8%, and the last basically 12 months it was 8.65, which is a little bit on their lower range when they're usually doing more 9 or 10%. This is, for having bad economic circumstances, still really good because they're still making a profit at the end of the day. The worst thing you want to do is be investing in a company that's starting to lose a lot of money during a bad time, because then you're kind of flipping a coin if it's going to recover or if it's going to go bankrupt. With Dollar General, we don't have to look at this. There's really no sight anywhere that this company could be going bankrupt. The worst case scenario is they're just making less money. And then we can also see at their net margin, you can actually see in 2008, it's slightly negative net margin, very low net margin 2009, then it started creeping back up and actually took a big boost here, which some of this may have been due to the inflation, the stimulus. They were able to get larger margins when people were spending a lot, but some of this net margin expansion is also just because of basically tax cuts. As we can see, the tax rate here was much higher, and then it's been down in the 20s, and that basically has led to this great EPS growth. Although right now we're maybe looking at under $10 for this next year, which is lower than 2021, lower than 2022. But notice this one thing of that, 2018, 2019, 2020, we're doing 564, 599, 668. Oh, didn't mean to do that. Then 1070. It was a huge jump, and this might be a company basically just actually digesting some of those gains because of the all economic conditions, the stimulus, inflation. It caused an unusual large jump in revenue and EPS. So let's just quickly check out their balance sheet. We have $8 billion in current assets versus $6 billion current liabilities. So they got a fine current ratio. We already knew they're in good financial condition. Long-term assets, almost $30 billion with goodwill of about 4.4. So we got to factor that, and the total liability is 23.86 there, and that gives total equity of 5.9 billion. But I always like to take that goodwill out since it's not really real in my opinion. So we're left with about 1.5 billion in total equity, mostly just in cash and receivables, or mainly inventories basically, which I think is one of the things they're actually saying in their earnings there, that they were working on decreasing their inventory still, which was a common problem that I've gone over with a lot of retailers had. They all got overstocked on inventory from the big boom in sales, and then they got stuck with all this excess inventory in 2022 and 2023. The situation is going to work itself out basically. And then we go down to the cash flow statement. You can see it's very simple business. They did do acquisition back here, but they don't actually grow off acquisitions. It's just pure opening new stores. And this is a good trend because this tells us the business is expanding naturally. They're not hitting this plateau, and they're actually spending record amounts every year opening up new stores. So I think this is a really good sign. And where do they put their money? They put it back to basically the buying back stock and a little bit into dividends. So overall, I think the company has great financials, but what does this really mean for the price? So I like looking at kind of a relative analysis and see, well, how does the market like to price this stock, and how is it currently pricing the stock? So one of the important ones I like to look at, for example, is the price to sales. We do have to also look at effectively the net margin, but let's actually get rid of the price here. We don't need to see that. But you can see our price to sales here is almost at a record low from when the stock originally went public. So that is telling us this is potentially extremely cheap. And now let's pop up the net margins, and you can see net margins have decreasing a little bit, kind of off this sugar high here from the 2021 inflation. But in comparison to these periods of time, maybe we're just reverting back to this mean of this period of time, and those are the sales going to be going forward. Or, that's probably the base case, maybe even the little bearish case. And your bull case is this is just a temporary thing, and their net margins are going to go back up, which means there could be a lot of a potential upside. And you can kind of see here that before, the price to sales ratio was maybe trading around this 0.8 to about 1.25, 1.3. And then when their net margins went up, they started trading more expensive because it looks like, oh, they're expanding their net margins, and now they've reverted back to that. So even if we compare to this lower margin time, which we may be entering, which is a bearish outlook for Dollar General in a way, because I'm saying what's actually going to happen is, their margins may contract a little bit more, or even to stay where they are here and never regain. And even in that scenario, it looks like we're trading potentially pretty cheap. And we can also see the same thing occurring with the P ratio. So let's bring up the P ratio and bring that up. And again, you can see back in the previous stage here, it usually traded between about a 15 and about a 22 or a 23 on average. And after there was that net margin boost, then it started trading at a higher ratio, about this 26 on the high side and only a 16 on the low side. And now that it looks like the stock is possibly reverting back down to the previous lower net margins, that's why it's corrected so much. But it actually looks like it's overcorrected to an extremely cheap value, as it's about a 12p right now, which is the cheapest Dollar General has ever been from a price to earnings, and even a little bit for the price to sales ratio. So another thing I just want to bring up here is if we look at the revenue with estimate, and we also want the EPS with estimate here. This unusual thing with inflation in 2021 is an anomaly. Basically, there was an extra boost in revenue, there was an extra boost in EPS, but it looks like things are just reverting back to the normal trend. And I showed this before, had happened with a lot of big tech stocks. When 2020 hit, they got a huge boost in revenue, and the reason why they got killed in 2022 is that, it looked like their sales are declining or their EPS is growing, the growth is dead, when really they were just digesting these huge gains which happened before, which is exactly, I think, what is happening with Dollar General right now, from what we can see from the financials and the whole other picture around it. So if we just bring up the chart for Dollar General here, we can see where it's trading. And one of the other reasons I really like Dollar General is this is a defensive stock. You can see in 2022, it actually did very, very well compared to the rest of the market. It has actually made net gains. If you bought it here, 200 up to 260, that's pretty good gains in 2022 when everything else was basically getting killed. And it also performs really well in a general bull market as well. So I think this is a stock that's going to perform good in the best of all environments. There is an inverted yield curve. There could be a potential recession coming into the future, but regardless of that, I think Dollar General could do well in that situation because they're a defensive player. They're very cheap right now, and people will go into it for that reason. If things start growing again, they're going to do well for that reason. If there's another inflation surge, they'll also do well in that environment as well. So looking at the price right now, it's really cheap, and I think Dollar General is very well positioned for all current economic environments going forward. Although you have to realize this isn't going to necessarily go up overnight. This may take a while. Like you can see back here, the stock came down. This was 2016 November, and it almost took 1 year. It was just under 1 year of going completely sideways, nowhere, till it really broke out and went into this bull run. I've maybe accumulated half my position I want in this right now. I'd originally started picking it in the 150s, and I got excited with this drop here, and I started buying in the low 130s, even got some in the high 120s today. And if it goes lower, that's great. I still have a lot more cash I wanted to put on this stock. So I hope you enjoyed this overall analysis of Dollar General. Remember to like, share, and subscribe. Stay tuned for the next video. I'll be going over a lot of the other stocks I picked in my previous video there.